Hello, everyone, and welcome back to another episode. I'm your host, a Millennial Investor, and in today's episode, we're going to give an update on my portfolio. Every single month, I give an update for you guys about my portfolio and how it's doing. We look at my annual dividend income, my monthly dividend income, portfolio value, monthly YouTube income. We look at all that stuff, and these are the updated amounts of the 22 companies that I own and what they pay me on an annual basis based off of last month, and we'll be updating it to next month. And if you look over here, we're going to scroll over to the right, and this is what you guys have been waiting for. Every single month we update this. We're going to go ahead and start off with our annual dividend income and our monthly dividend income. These are both brand new records, so go ahead and take a mental picture, and here's the update in 3, 2, 1. And there you go. There is the new records for the annual and monthly dividend income. Honestly, guys, when we look at portfolio value, the value of my portfolio, it currently sits at a little bit over $12,300. And this varies significantly. This is constantly moving around literally by the second. Look, let's go ahead and update it. It's 12,359. If I go ahead and update it, it's 12,352. It literally updates by the second. This is constantly moving around, but my dividend income is constantly going up. It is almost never going down whatsoever because we constantly have a reinvestment of dividends. We constantly have a reinvestment of my own deposits. We constantly have a reinvestment of referrals to M1 Finance that you guys help supply me with. And this causes record after record month. Every single 30 days we update this, and we constantly beat our own record again and again, time after time. And now we are reaching upwards of $400 a year in annual passive income. My monthly dividend income did reach a new record as well. We have never hit $40 before, and we just broke past that. So last month, I got paid over $1 a day just to sleep. Right now, as you can see, like I'm edging up towards 400. Right now, every night that my head hits the pillow, I make over $1 a day. So if I sleep a week, if I sleep in 1 week, then I'm going to make over $7. If I sleep in the whole month for 30 days, then I'm going to make over $30 when I go to sleep. And March is obviously one of the big months, so that's why it's a little bit above average. But you can see quarter over quarter, it is steadily trending upwards. You can see how this chart is getting higher and higher. June, September, December, March, those are the big months, and you can see 13, 16, 30, 40, quarter over quarter, this is steadily increasing as I deposit and buy more of the same companies that I've been owning. But let's go ahead and get off of that for a second, and let's go ahead and take a look at the portfolio value and monthly YouTube income, and let's go ahead and give you an update on these charts in 3, 2, 1. Okay, so there's the update for my portfolio value and my monthly YouTube income. Last month was a absolutely blow away record month for the YouTube income in February, and I knew we wouldn't come anywhere close to that. And honestly, I don't expect to get anywhere even close to that level anytime soon. But if I can steadily pull in $100, $200, $300 from the channel, that'll definitely help me increase my value to you guys as a YouTuber, but also increase my portfolio value over time as well. And that is what has partially helped this steady uptrend, because month after month, we have had an increase every single month in portfolio value. That counts the market going up. That counts the market going down. As the market moves, because of the way that this channel works with the reinvestments from dividends, referrals, and my own deposits, it is just a steady uptrend, guys. And the last 2 months have really taken off due to all the referral money that I've seen from this channel. And we finished out the month of March just at $12,000. So very good news there. We're going to hopefully beat that record this month. So far, we're already doing well on track to beat that as well. But I'm very happy with these charts. I'm very happy with the success of the channel. And these are my 5 investing goals for 2021. If you haven't seen me before, I have these 5 goals, and they're very important to me. And I want to reach all 5 of these, and I want to beat them by the end of 2021. And this is my 2021 stock market prediction that I made on January 1st at the beginning of the year. And one of those goals, if you didn't notice, was to get people referred to M1 Finance. So far, we've had 103 people sign up. They've slowed down a little bit, but the good news is when you get signed up with M1 Finance, if you're watching this video and you're not signed up already, I have an opportunity for you to make some free money. If you download this link that I'm hovering over with my mouse right now, it is down in the description. If you download it and deposit $100 to the platform, you'll get $10, and so will I. But if you deposit $1,000 to the platform, you will get $30, and so will I. So you'll help support the channel, you'll help fund your investment journey, and I think it's just a great way to get started with all the features and benefits that M1 Finance has to offer, and they're constantly coming out with new features and benefits for its M1 Plus users. But overall, guys, there's lots of things in the description to check out as well, including savings accounts, credit card referrals, and my pie firsthand if you want to invest in it or look at it yourself. This is not investment advice, but I'm about to go over the 22 companies that I own and why I own them specifically and why they think they're going to be incredible investments for the future. But I hope you guys enjoy this video, guys, and let's go ahead and jump into my #1 investment, the company that I put more money in than any other, and that's Broadcom. On a money weighted return, It's starting to get a little crazy. It's up another green day here today. Look at that, 1.99% in the green. I now own a little over 2.25 shares of this company at an average share price of 348. I originally started buying this company in the low 200s, and on a money-weighted return, when you count in cash flows from dividends and market gains, we are up almost 100% on this company. Now, time-weighted return is obviously a lot lower, based off the time that you own the company, not factoring in cash flows, but still, this is some incredible performance that this company is seeing. This is the 5-year chart, and where I'm hovering my mouse at right here, because I started in April of last year, we're right at my year mark, I started buying it at these levels right here, and I bought it all along the way, and it seems like pretty much every day is a green day from this company. And the reason why it is because when I started buying this company, its PE ratio was significantly lower. It also has incredible cash flows. It has an incredible amount of patents on the semiconductor products that it offers. It's a software company. It's a hardware company. They're in a growing industry, or I should say growing industries, plural. This is a company that I see will be successful for the next several years. This is a company that could go up to $750 a share tomorrow. It could have a 50% green day, and I would still own the company. I do not want to sell it. I want ownership in Broadcom, and that's why I intend on owning this beast of a dividend stock for the coming years. It's done me very well so far, and I think it's going to do me very well in 2021 and in the future. Next up, we have tied for my second and third place most heaviest investment stocks. We have WP Carey and Realty Income, and they are very, very, very similar companies. They are both triple net lease real estate companies. What they do is that they buy properties, they then lease it out to customers, very high investment grade customers that will pay their rent pretty much no doubt whatsoever. These companies like WP Carey and Realty Income rent out to people like Walgreens and 7-Eleven and your Home Depots and a lot of investment grade high profitability businesses that are able to pay their rent 99% of the time. The cool part about these two companies is that they're both triple net lease real estate, which means they take on a lot less obligations and a lot less liabilities that a lot of other real estate investment trusts have to take on. They usually pass things on like maintenance costs and property taxes and all the hassle that goes along with owning real estate. They pass that along to the tenants and say, hey, we don't want to worry about it. We just want to own the real estate and you guys can rent it out from us. We just want to sell the land and the building to you. This is what causes these companies to be massively profitable, to pay out massive dividend yields, and to raise that dividend constantly. Both of these companies pay out dividends consistently, and both of them raise their dividends at least once every quarter. They've been on a massive track record. I believe Realty Income just raised their dividend last week, and I think that was 110 dividend raises in a row, if I'm not mistaken. It's in the triple digits. It's something absolutely insane. It's crazy, but both of these companies will be successful in the future. Their high dividend yields, as well as their opportunity for share price growth long term, I think will make your total return massive, and that is why WP Carey is my biggest dividend payer. It's to the point now, actually I kind of want to add it up just because I'm curious. Let me pull out my calculator here. So I own 13.22964 shares. Multiply that times the dividend payment, which is right now 1.048, and you take that number and you find out that right now my dividend payment now from WP Carey is almost $14, $13.86 to be exact. So every single quarter, I'm going to be getting a growing dividend payment of what is already almost $14. It is very soon that we'll be looking at a dividend payment from WP Carey every quarter being $15, $25, $30, $50. It is very soon that we could probably see in a couple years from now this being a $100 payout. Just this one company, not counting all these others, every single quarter getting a $100 payout from WP Carey, more than likely within the next, I don't know, I want to say 2 or 3 years, so stay tuned for that. But next up, we have one of the highest growing companies in the portfolio, the one that I'm not worried so much about the dividend. I will just want to focus on the dividend growth and the potential share price appreciation opportunity with this company. Now, one of the things that I think is really interesting about Visa is their business model. This company, if any company screams profitability, it is Visa. Visa has a wicked amount of profitability. I think I saw the other day, we were talking about profit margins, and I was looking at comparing profit margins of different companies, and I was talking about how JPMorgan had a very high profit margin. And one of the only companies on the list that actually beat JPMorgan was Visa. It said that right now Visa keeps around 48 cents out of every dollar in revenue purely in profit. That's not gross margins, that's profit margins. So after everything's said and done with labor and cost of goods sold and rent and utilities and all that other things that go along with owning and running a business, after every dollar of revenue that they earn, 48 cents roughly is kept in profit. So about half of all revenue they get just goes to the bottom line, to profit. This is a business model that I love because when people issue credit cards, they have to worry about getting paid back. That's not the case with Visa. If you go to, let's just say, JPMorgan Chase, another company that we're about to go over. If you go to JPMorgan Chase and you open up a credit card, and let's say it's $1,000, okay? And you rack up $1,000 worth of purchases on that credit card and you don't pay any of it, that hurts JP Morgan. JP Morgan has to eat that loss. They'll earn a little bit of revenue when they issue you the card. When you swipe your card, they get a little small exchange fees, whatever. But at the end of the day, JP Morgan is going to be the loser out of that. Who is not the loser is Visa. Because when you issue the card, when you initially get the card, Visa gets paid a fee. When you go to those different stores or whatever or online and you rack up $1,000 worth of purchases, you make a purchase, bam, Visa keeps a percentage. You make a purchase, bam, Visa keeps a percentage. And regardless as to whether or not you pay that back, Visa already got paid. And this is such a high margin business, such a high growing industry, and people are constantly switching more and more towards credit cards, debit cards, online payments, mobile payments, and away from boring old cash and typical checks, that I think that Visa is set up perfectly for the future. I don't care what this company is trading at right now. It's at $220, awesome, great. I'll buy it at those prices. I'll buy it at $250. I'll buy it at $300. I'll probably even buy it upwards of $400 a share in 2021. I'm very bullish on this company. The lower it goes, the more I buy. So I wanted to stay low. The dividend yield sucks right now, yes, but they have a consistent pattern of every year other than 2020 raising that dividend 10% plus. So while the dividend payment is low now, I know that out of all the companies that I own, out of all 22, I expect Visa more than likely to be the fastest grower of the bunch. If not Visa, then definitely Lockheed Martin, which we're about to go up just next. Home Depot is another one. Speaking of fast growing dividend payments, this is the company that just raised its dividend 10%. If you look at that chart, let's go back. You see that big spike up? I was looking at the numbers on this company, looking at price to sales, looking at PE ratios, and overall just looking at the profitability and the future of the company. And I saw, I believe, March 8th. Yeah, that was when I just started to buy a lot more of this company. I increased my position in it. March 8th is when I increased my position. And let's look at how this company has done since March 8th. Let's see, March 8th is right here, 259. It has been nothing but pretty much green days ever since. That March 8th price was $259 a share, so I started buying it at $260 really heavily. And I'm really upset because I wanted this company to stay down or go down even lower. But it's went from $260 now upwards of $300+ a share, and it is now at its all-time record high. I'm still very bullish on this company at $300. I so wish it would go back down towards that $250 range. I don't think it's going to happen. This company is too profitable. They're growing too nice. And this is a company that when you hear about stories of, oh, brick and mortar retail is dying out, Amazon is going to take over these companies, they're just going to be gone, right? I think when you look at that story, it doesn't really fit with Home Depot because they're a specialty retailer. They are a home improvement store, and they really only have one competitor, which is another company I'm a huge fan of, which is Lowe's. The Lowe's is a company that has a very high growth home improvement story, just like Home Depot. This is one of the only real competitors that Home Depot has, and this is a higher barrier to entry business. It is not easy to have the capital to build out stores of mass scale like Home Depot and Lowe's have. They already have a massive moat, they have massive profitability, and they're adapting to consumer trends such as mobile pickups and things like that. Home Depot is a company that I like. They're a very good margin business. They are pretty weak to recessions, that is true, and that's why you did see that massive downturn in 2020, but they've proven to bounce back. They've held dividend payments throughout 2008, 2009. They've held dividend payments throughout the 2020 recession. I think that's going to continue. Home Depot will continue to be one of the largest positions in my portfolio as we move forward. Don't ever expect me to sell Home Depot. For me to sell Home Depot, massive downturns would happen, and it would just have to be where the company was just no longer ever going to be successful the way that they are now. But Home Depot is one that I love. And speaking of one that I love, this has also been steadily increasing in my portfolio to one of my largest positions, Lockheed Martin. Up again here today about 2%, and I hate to say I told you so, but I started buying this company in the low 300s. Actually, what's my average share price? And it's averaged up quite a bit. $350. I'm curious, so let's go ahead and look. I want to see what was my initial purchase with Lockheed Martin. I actually don't even know. I kind of just want to see. Let's go down to the first purchase. Okay, November 17th. I started buying this company at $3.77, and I bought it heavier and heavier along the way. You see, some days I bought a lot heavier than others, like February 16th. I bought it at $3.38. I believe that was my biggest purchase. I bought this company heavily in the 330s, 340s, whatever. But if we go back to my portfolio and we scroll down to Lockheed Martin, let's go to Lockheed Martin. It is now almost to $380 a share. And so I was buying it heavily on this dip, and I just saw the numbers of this company. The quantitative analysis that I saw of this company, the number side of it, was just breathtaking. When you saw the fact that the government is the most important customer of this company. If you saw the financials of this company, they only pay out less than half of their profits in the form of dividend payments. Wow. They have a backlog of billions and billions and billions of dollars. This is a company that has had many mergers and acquisitions over the last couple of decades that has made it what the company it is today. They just bought out they just announced another acquisition as well. So let's look at Aerojet Rocketdyne. Oh, okay, there it is, AJRD. I couldn't remember the ticker. Aerojet Rocketdyne is another company. You see this big spike up? See this massive day where they shot up, what is that, like 20%? That is when they announced that Lockheed Martin will potentially be buying out this company. It has to be approved by the government first, but as soon as they get the green light, this is just going to be one more growth story for Lockheed Martin. When they acquired this company, they now have all the technology, they now have all the profit. Oh yeah, by the way, Aerojet Rocketdyne is already a very profitable company, so they're going to get hold of those profits as well. They also have many backlog orders for the space sector that Aerojet has. Lockheed Martin's going to be acquiring that. They're now going to have more profits, more revenues. They're going to have the technology that Aerojet already has in place, and now it's all going to go to Lockheed Martin. This is just one more reason why I'm so bullish on this company. The profitability is massive. The PE ratio is so much lower than any other company I can find compared to a high growth dividend stock like this. This is a dividend that is growing pretty much just as fast as something like a Visa, but it has a yield that is 5 times higher. Its profitability is almost just as high as that of Visa. And when you factor in share repurchases and dividend payments that are growing at this scale, I'm going to go ahead and go on a record here that I say in 2021, this company probably breaks $500 a share if it gets to the valuation that it deserves. If it doesn't, if it stays below this $400 a share range, I will continue to buy this company heavier and heavier. If it were to go over that 500 level, I'm not selling a share. For me to sell this company, it would have to be ridiculous prices. Like in 2021, it would probably have to reach like 1,000 or something crazy. I'm not selling Lockheed Martin anytime soon. I love the company, I love the business, and I think it is going to be a big winner in coming decades. Pepsi is one of my favorites, both as a consumer and an investor. It's pretty much stayed flat from where we own it. I own it at an average share price of $135. It's trading at $143, but I've just steadily bought more and more shares. It's kind of traded sideways. It's went up, it's went down, but you see in the last year, it's pretty much stayed the same. It's stayed within about a $10 trading range, and that's good because when it stays at those levels, the dividend gets raised, I get a higher dividend payment, and meanwhile, this company continues to grow revenues, grow profitability. And speaking of buyouts, just like we were talking with Lockheed Martin buying out Aerojet Rocketdyne, we have Pepsi buying out things like Rockstar. That will be hitting their revenue stream this year as that buyout goes through. That is just more revenues and profits for Pepsi. That is one more brand of their massive portfolio of brands that Pepsi has to own and collect profits from. Pepsi is a company that I love as a consumer as well because I'm looking over to my left and I'm looking at my snack section. I have Doritos. I have Tostitos chips. I love Mountain Dew. I love Matador beef jerky. I love all the brands that this company has to offer. I'm a huge fan of them, and they continue to slowly grow over time, increase those revenues and profits for shareholders, and that's why they are on the brink of becoming a dividend king. They just raised that dividend the 49th year in a row, and next year when we have this conversation in 2022, they will be a dividend king of raising that dividend 50 years straight. So I love the company, and speaking of companies that have very long track records of raising their dividend, it's Kimberly-Clark. This is a company that has went down a lot in share price. People are worried about pricing power of the toilet paper and paper towel and napkin aisle, and I'm not. This is a company that people don't buy their products for the price. Not really. I mean, because if you want to worry about price, you're going to buy a great value brand or whatever, right? People buy Kimberly-Clark for the branding power that they have. Look at some of the brands that they have. Huggies, Kleenex, Scott, Kotex, Cottonelle. These are brands that people buy because they're familiar with them. And it's funny, I read something interesting the other day. It was talking about that toilet paper companies naturally made you think that the toilet paper is supposed to go on the top, which that's how I use it as well. Not to go over bathroom habits, whatever, but if you look at the toilet paper roll, you'll notice that on the top, when the toilet paper roll is over the top, they have like little flower patterns and thing like that. So that way way it makes you think that that's the way it's supposed to go. Because they found that when people use toilet paper on the top rather than rolling it from the bottom, the toilet paper rolls easier from the top, and you typically on average use 30% more toilet paper. When you use 30% more toilet paper, you also have to go out and buy more toilet paper because you're flushing it down too quickly. That is just one more way that I think is brilliant for something like a Kimberly-Clark to manipulate their users into using more toilet paper. It's something that's been around for ages and a lot of people don't even know it, but that's just one example. When you look at a company like this, they're massively profitable. They just raised that dividend another 6.5% or so, and they initiated a new share buyback program. So not only will I be buying shares at these discounted levels in the 130s and 120s range, but the company itself will be buying them. So that means more profitability, higher earnings per share numbers because there's less shares available, and that just gives me an opportunity as an investor. So if these prices stay down, and if they were to go even further, if they were to go to the 110s or the 100s, it would probably be one of the largest positions in my portfolio for its defensive nature. Procter Gamble, speaking of companies that are defensive, this is a company that has downtrended in the last couple of months. They're starting to come back a little bit, but in the last couple of months, this company has went down and down and down. And at one point, they were at the 120 range. This company is a very defensive company, sells basic things like shampoos and deodorants and paper products and things like that. Procter & Gamble is one of your old school dividend stocks. They're the old timer of the stock market, right? This is what your grandpa invests in, but this is what I like to invest in too. Another cool part is that if you notice, they have a track record of raising that dividend every single year, usually in the month of April. So they're due for another dividend raise here. Maybe they already have raised it. Maybe I just haven't been up to date yet, but they should be raising that dividend any time now. So expect another 3, 4, 5, 6% raise, and that'll just make me more profitable on my original investment with Procter & Gamble that I've been buying over the last year or so. Procter & Gamble is one of my forever stocks. I never plan on selling it. And the same thing goes for these next two companies. 3M. 3M is a company that has finally started to pay off in terms of share price. Now, the dividend has been great. It's done very well. But if you notice, I was talking about this company a lot in the middle of last year. I was talking about buying this company in the 140s, the 150s, and especially into the 160s and below. I was talking about buying this company like crazy. And now it's steadily uptrended. If you look at the year chart, it is a steady uptrend week after week and month after month. And we are now upwards of almost $200 a share. We're finally about to break that $200 mark. And this company is starting to get back towards a growth story. They're slowly growing their revenues. They had a couple of rough years between the pandemic with 2020 and a couple years before that, and while the share price did get ahead of itself, while now you can buy these shares at still $200 a share, I think once this company gets well past its $200 a share range, I think that's the last time it ever gets below $200 a share, given that the company doesn't split the stock in the future. This company is massively profitable with 60,000 products currently being produced. 60,000. Between 60,000 different products and 96,000 employees, there are so many different areas that this company is invested in that it's hard to think that it doesn't grow as the economy grows alongside it. So as unemployment starts to go lower, as the GDP grows, 3M is going to be there to take advantage of that with its massive array of products. And this is one of my forever stocks. They produce so many things and they're so invested into the future and the long-term value of the shareholder that I just couldn't ever see myself selling 3M at realistically almost any price. Now, Johnson & Johnson is one that is also one of my forever stocks, and the one reason why I'll never sell this company is because it's the only healthcare stock that I own. I've considered some other names in the space like an AbbVie for a pharmaceuticals play, but Johnson & Johnson is just by far and away the best company in my opinion when it comes to healthcare. There's no company that you can really compare it to. And I've heard people say in the past that owning Johnson & Johnson is almost like owning a healthcare ETF, and I would agree with that. They're in so many different areas with their surgical equipment space and their pharmaceuticals and basic household products like Listerine and Band-Aids. Johnson & Johnson is just going to be a winner long term, regardless of what happens with the healthcare sector, regardless of what politicians say that they'll do with healthcare, even if the space does change in the next 20 years, which I think it probably will in some way, shape, or form. Johnson & Johnson is still going to come out on top. This company was a winner in the 70s. It was a winner in the 80s. It was a winner in the 90s, the 2000s, the 2010s, and they're going to be a winner in the 2020s. That's my opinion. That's what I think. And as this company continues to buy back shares, raise those dividends, and even have incredible share price performance despite its old age, I think that Johnson & Johnson is one that, once again, I think that I will never sell out of. It's a company that's one of the only stocks in the stock market that has a AAA credit rating, that and Microsoft, and I just think it's one that I got to own over the next 10 years. JPMorgan Chase, one that has had a massive uproar in share price in 2021. I was talking about over and over, making videos. Guys, buy the stock, buy it in the 90s, buy it in the hundreds. And now look at it. It's 153. My average share price of this company is 101, and that's actually just because I raised it. I just bought, I think like another half share of this company or something like that. I had an average share price of 99. Now it's upwards of 101 because I'm increasing that share price. But JP Morgan Chase, guys, we were talking about profit margins earlier. The same thing goes with the JP Morgan. They keep almost half of their revenue in the form of profit, bottom line profit. And now that a lot of the restrictions for both buybacks and dividend payments are about to go by the wayside, expect two things. The first one is you can see that this company has been buying its own stock heavily. And you can see that this company has had a track record of raising that dividend. Now that they've had a year off from raising that dividend, and they have a lot more capital on the side, and they're not worried nearly as much about a recession today as they were 1 year ago, I think that the dividend will start to heavily go up. I think that it's 90 cents a quarter now. Expect that to break $1 in 2021. I wouldn't be surprised. If not, definitely by 2022, they'll start to break well over $1. I think that the next 5 years, as far as dividends and share repurchases go, I wouldn't be surprised if 5 years from now in 2026, if this company's dividend payment is something like, I don't know, $1.25 a quarter, maybe 30-40% higher than it is now. So yeah, JP Morgan, one that I'm going to be holding on. I bought a lot of shares early on, but I'm still a buyer in the 150s. One that I'm very bullish on. It's the best financials company in the world, in my opinion, and it's just a safe stock that I can hold out throughout any recession. It's one of my best performers as well. As you can see, the money-weighted return on this company is 112%, so doing very good. Southern Company is one that is just your old boring grandpa stock, much like a Procter Gamble. They're a boring utilities company. They provide electricity and natural gas to consumers, and basically this is an old boring regulated stock that will slowly grow as inflation and population grows over time. I think that Southern Company will have very, very slow growth and very slow dividend raises, but it's going to be a steady payer. It's not going to be a big money stock. This is not going to be a stock that I doubled my money on. I made 50% returns this year. That's not going to be the case. I'll probably be within like a 10 or 20% range of where I buy the company at pretty much all the time because it doesn't move a lot. But that said, boring is good sometimes. It has a great dividend yield for even this high-flying market. It's still trading at a pretty fair PE ratio. I'd like for it to come down a little bit, preferably below the 60s for me to really start getting interested again. But Southern Company, one I like to own, one that is definitely going to be an easy money stock. McDonald's. McDonald's is one of my favorite companies. I always talk about if you haven't seen The Founder yet on Netflix, go watch it, and we are now approaching upwards towards a new all-time high. It started to dip almost towards that 200 mark, but we're starting to come back now, about a 10-15% increase. And speaking of increases, the dividend has a track record of usually getting raised in the high single digits or low double digits. Now last year was the one exception, and only got raised about 3.5% or so, but I think that this company moving forward will go back to raising that dividend massively. Once again, we talked about 5 years out with JP Morgan. The same thing goes to McDonald's. The profitability is coming back and is starting to get into new all-time high levels, just like where we were at the beginning of 2020 and late 2019. I think that 5 years from now, don't be surprised if this dividend payment is well over $1.50, upwards towards $1.75. This is a company that has continued mass profitability from the real estate holdings that they have, and of course selling their boring burgers and fries. And they're also focused on new things as well, like new consumer trends like a Beyond Meat, for example. They're coming out with things like the McPlant. They also have their recurring revenue streams from fun items like the McRib and the Shamrock Shake and things like that. McDonald's is just one that I love. They target children, so people usually end up loving them and owning them for life. So McDonald's is one that I like. And speaking of one that's an old boring stock that a lot of people usually end up using for life, Coca-Cola is one that a lot of people have been very pessimistic on. A lot of people have not been very bullish on Coca-Cola here in 2020 and early 2021. I think that as this company dipped below $50, it was a steal. And I think even now at $53, it's still a pretty good deal. It might be trading at a little bit high of a PE ratio, where it's really attractive to me is under 50, but this company has a massive yield. They also raised that dividend another penny. They raised it just the other day. And I think that this company is one that I'll anticipate on owning for life. If they continue to reinvest back into their business, if they continue to get mass profitability as they expand into new brands, as they create their own brands, as they buy out other smaller beverage companies, I think that Coca-Cola is going to get back on a growth story. I think that 2021 will kind of be the recovery year, And I think that 2022 and beyond is when this company really starts to turn around. Between their new alcoholic beverages that they have come out, with their Coca-Cola with Coffee brand, as their new brands come out that they haven't mentioned yet, that they're probably going to be releasing more as well in the coming years, I think that Coca-Cola will start to get back to a growth story. They're not really growing so much now, but they are focused on profitability, and that is what kept this company afloat. Because they can sell a Coca-Cola for $2 each and then produce them for pennies on the dollar. So that's why I love Coca-Cola. They're a great business. They'll find a way to turn it around. And Caterpillar. Caterpillar is next. This is one that is actually, it might be one of my top performers, and I never thought that would have been the case. I thought that Caterpillar was just going to be an average stock that probably moved little to nowhere in 2020. Now, when I originally started buying this company, there's actually times I believe I actually bought it under 100 or like right at 100, okay? I started buying this company at 100, 110, 120, even in the 130s quite heavily. And once it started to get upwards of 140, 150, I was like, okay, it probably doesn't have a whole lot of room left to run. Boy, was I wrong. The good news is I never sold out of any shares. I held out of everything I had, but I started to slowly buy less and less of the company because I thought that, okay, this company probably won't run a whole lot more. And it was trading at a relatively low PE ratio, but things were still uncertain with the economy. And I think that the profitability for Caterpillar was probably being overstated at the time. And then rumors of the infrastructure bill have become greater and greater and more likely. And it's gotten to the point now where it's a straight line up. If you would have told me 1 year ago that Caterpillar would be a $230, $240 stock, I would say, woo, I think you're a bit optimistic there. I love the company, I want to own it, but $240, I think that's a bit much. The good news is, if the infrastructure bill passes, not only will my old shares already have a lot of gains, but I think future shares will also have a lot of upwards opportunity as well. The good news is that all these shares that I bought low here at 100, at 110, at 120, at 4+% dividend yields. You see this dividend payment of $1.03. They skipped raising that dividend last year. And that means that they are going to probably follow their track record of raising it every July. They skipped it last year in 2020 with the uncertainty going on with the pandemic. But I think that in July this year, they're going to raise it. And I think if the infrastructure bill passed, talk about July of 2022 and 2023, I expect this dividend to go up massively. I'm going to expect probably some double-digit raises. And so that's why I even held out throughout this company without raising that dividend in 2020. They kept their payout. It's not that important. But this company is one that I like. It's an industrial company that I love owning, and I think they'll do just fine. Let me rephrase that. I think they will do very well on the business side of things. Regardless of where the share price goes, I think that the business will do very well in 2021 and very well in 2022, even better in 2022. I expect record numbers for Caterpillar in 2022, 2023. I think share repurchases and dividend raises are going to be massive. And Altria is the company we have next, and this is a company that people were very pessimistic on. A lot of people are still pessimistic on it. And when I was buying this company at 40, in the 30s, right? At $40 a share, I said, wow, this company offers a lot of value. And you can see that they currently pay out a dividend payment of 86 cents a quarter. So let's take that number, 86 cents, and times it by 4. So for every share that you buy, you'll get $3.44. Now let's figure out the yield at $40 a share, where these levels are, where my mouse is at. If you take $3.44 and you divide by 40, that will give you a dividend yield of 8.6%. Okay? Even at these bottom levels, you can see that this company was paying out almost a 10% yielder just 1 year ago. Less than a year ago. What is that, like 6 months ago? And if you go actually back towards a year ago, 2 years ago, there was actually times where it was a 10% yielding stock. And people are so bearish on the smoking space. And I get it. People are not smoking cigarettes like they used to. But this is not just a cigarette company. For now, they are having their boring legacy smoking business, but they're raising the prices so they can increase profitability to invest into other areas, with their other sin stocks, so to be called, with the MJ space, with the marijuana space, with the alcohol space. They are constantly reinvesting back into more and newer businesses. They have a 45% stake in Kronos. They have a huge stake in Anheuser-Busch as well. And this is going to produce cash flows long term for this company to reinvest into those newer businesses. They're working on newer things like smokeless tobacco and other businesses as well as like their stake in Juul is still a thing. I know it got hit heavily with regulations and such, but Juul is still probably going to be a long-term winner in my opinion for this company. And I think Altria It's just people are too bearish on it. I think when I was buying this company at 40, I did know the risks. I know that they're at risk of a dividend cut, and I think it is definitely a turnaround play. But even at 50, even at $50 a share, let's go look again. What was it? $3.44. Divide that by 50. This is still almost a 7% yielding stock. So when you factor in the fact that this is already one of the best performing total return stocks over the last couple of decades, and the fact that even though this company is paying out a lot of its profits, this company has incredible profitability, and the consumer demand of this company is massive for people that are already addicted to nicotine. Nicotine is a choice, I believe, in my opinion. I think that people have the choice to smoke cigarettes. If they want to quit, they should work on stopping. There are obviously negative side effects that come along with smoking, and I'm not endorsing that whatsoever. But I'm saying if that's the case, Altria is going to reinvest back into its cigarette business, but more importantly, into the businesses that are moving towards the future with smokeless tobacco and marijuana and alcohol. And I think that Altria will be a long-term uptrend. I think over the next 5 years, this chart will not be a downtrend. I believe that it will be an uptrend. I think that 5 years from now, we'll probably see this stock be upwards of $70, $80, $90 a share as this company gets back towards massive profitability and they return even more capital to shareholders. So I'm excited with Altria, a turnaround play that is definitely starting to prove right, and I'm glad I started investing in that company early back in 2020. Store Capital. Store Capital is another real estate investment trust, and it's very similar to that of WP Carey and Realty Income, and it has started to return massive returns. I started buying this company very heavily, even below $20 a share. I started buying this company at 20 and 30, and now it's starting to get towards the mid 30s, and I'm sure it will be very, very soon that this company gets towards $40 a share again. I think that even at $34, $35 a share, this company is still very undervalued. They're not far off from their IPO price at 2014, and since 2014, they now have a way higher dividend payment. They have way more properties, a lot more profits. This company is still undervalued in my opinion, and that's why I continue to hold it. I don't really want to increase it because I already have a lot of real estate in the portfolio, and I don't want to increase it anymore, but it's a hold. I'll continue to buy shares for what M1 Finance lets me do at 3%. I'll continue at that 3% level, and I'll continue to buy small amounts and hold whatever I have. In the meantime, I'll get a great dividend payout, and I think long term the share price opportunity is going to be great as it gets to turn around from this pandemic area in 2020 like it did with Altria. I think that this company will begin to turn around long term. NextEra Energy Partners is 2% of my portfolio, one of the only renewable energy plays in my portfolio, the only renewable energy play in my portfolio, and this is a very underrated stock. It raises its dividend not every year, but every quarter, and is one of the highest yielding stocks that I can find in the stock market, very above average. It currently has almost a 4% dividend yield, and NextEra Energy, guys, is just one that I think is going to be a great play long term, as the renewable energy space is definitely going to be a high growth category, not only with the infrastructure bill, but with the way that the country and, well, I should say globally, the way that us humans are moving. I think that renewable energy is going to be a good long-term play, and NextEra Energy Partners is one that I'm excited about owning. Now, this number right here, the newest addition to the portfolio, this is one I owned in 2020, and I'm buying back in 2021. And this is one that is kind of a cyclical play. It moves around up and down very heavily. And that money-weighted return is not fully accurate because I've only owned it a week. Money-weighted, I've had a massive return, but I've only owned this company for, I think, like, 2 or 3 weeks now. I bought this back in this company at, March 8th? So, yeah, less than a month. So, like, 3 weeks I've owned this company. I bought it at $197, and I haven't been able to buy any shares since, because if you go back to March 8th, the day that I bought this company, when I bought heavily into it, at March 8th, let's look at that day. So, right here at 201. I bought it at 197 at open. It was a little bit lower. So basically about this price. Every day it's been green. Green day, green day, green day, green day. Every single day this company's been up. And guess what? This was Friday's close here at 225. Well, let's look at the share price today. It's up 2.6% again here today. It went right back to new all-time highs, right back, or I should say the last high that's seen the last couple of years, right back to 230. Whirlpool produces basic things like washers and dryers and dishwashers and things like that. And Whirlpool it's still very undervalued levels in my opinion. It is a very boring stock, and I think that it is really underappreciated considering the levels that it's trading at. Even at $230 a share, I think it's still really undervalued. even at 250, I think it's still really undervalued. So that's one I'll keep in a small position in my portfolio, not as bullish as say something like a Broadcom or WP Carey for example, but one that I like to own. It's better than keeping cash on the side and just getting eaten away at inflation, right? And we also have two more. We have one that is very defensive, or actually both of these companies are very defensive, but Waste Management, in my opinion, is one of the most defensive, if not the most defensive in my portfolio. Because the way I look at it, no matter what happens with the economy, what happens with unemployment rates or interest rates or things like that, people are always going to create trash, right? Okay. The population will grow and will create more trash. That is going to probably be a 99% chance that will happen. That 5 years from now, we're going to create more trash than we did in 2021. 10 years from now, we're going to create more trash than we did in 2021 or even in 2025. I think that this is a company that has a growing industry while it is very boring. I mean, who wants to talk about investing in a trash service, right? Well, I do. I think that this is a company that continues to return capital to shareholders from its steadily growing business model. Not a high growth business model. It's not going to be growing 10, 20, 30% a year, but a steady trend of, I don't know, say 5% growth, a 5% CAGR, compounded annual growth rate, could be steady for this company over the next decade. This company can consistently grow its revenues and profits 5+% over the next decade, I believe. So as they also buy out more smaller trash companies and services as well, I think that this gives an awesome opportunity because they're starting to become a Goliath in this space. As far as the trash service goes, I think that Waste Management is starting to become the dominant player, and they are growing and growing and growing by the day. As they start to acquire more and more smaller trash companies, I think that this is really going to be a big winner. A lot of stocks in my portfolio are kind of sleepers, in my opinion, from what a lot of people pay attention to. And I think that Waste Management is one of them. A lot of people don't give this company credit what it deserves, but I think that it is going to be a winner long term. Go ahead and check near your local businesses and in your area, and you'll probably notice this WM logo. They probably already service trash in your area. So go ahead and check that out next time you go outside. But last but not least, we have Verizon. Verizon is one that I've talked about a lot. And Warren Buffett just announced like a week after I made my video, that's what this big spike up was right here. And you notice that this company has pretty much went nowhere in the last year. You notice that this company's went nowhere in the last 2 years. You notice that in the last 5 years that this company has once again went pretty much nowhere. But that dividend payment has went up and up and up and up. And this company just financed one of the largest bond deals that has ever been financed in the history of the United States. And I think that this company is investing long term towards its 5G growth story. I think that long term, this company will get back to new all-time highs. I think it will break well past $60 a share over the next 5 years. It's not going to be a short-term thing. It's not going to be 6 months from now. It's not going to be a year from now probably. But on a 5-year trajectory, I think that not only will the dividend get a lot higher, but I think the share price will start to uptrend as well as they finance those bonds at ridiculously low prices. They'll benefit from the long-term growth of the new revolution of cell phones, which is 5G. But I hope you guys enjoyed this video. These were all the companies that I own. Like I said, if you want to get signed up or if you want to invest in my portfolio yourself, it's all down below in the description. You can get $10 or $30 for getting signed up, but I really appreciate you guys watching all the way to the end. Get an update next month, but I appreciate you guys for tuning in, and I'll catch you guys next time.